What steps should people take to ensure that the door is locked?
Great question. You can first and foremost make meetings private. One of the issues, there was an entire currency of people putting on something onto Facebook, and Facebook isn't exactly the most private platform in the universe. People were finding these links and they were just inviting themselves to the party. The same thing is, putting a link for a Zoom site onto a web-facing, a website, hoping that security by obscurity would protect you. Well, unfortunately, security by obscurity is dead. So if it's anywhere that's internet facing and is not being particularly private or protected, it will be discovered. And then, as we found here, it's taken advantage of. So step one, keep meetings private. 2, in the case of Zoom, don't, as much as it's easy to say, hey, use my personal room, refrain from doing that. Schedule a meeting. That way the meeting has a beginning, and when you end the meeting, it has an end. It's not like an ongoing room thing where people go in and out, because that into itself also lends, it can be abused. 3, going back on that piece of, the fact of me keeping the meeting private. That is now a default setting in Zoom. So that means, hey, make it private. Make sure that you are taking advantage of that fact that it's private, and so that you then use an out-of-band delivery mechanism, this outdated thing called email. Not that outdated, but point being, it's from a lot of people's perspective, sending it not through like a social media site or Twitter or something like, don't use that. Use email. These things is very specific, pointed to a person. And this is very important when you think about like online learning, where people are coming together. And so if you start combining these things, where you're not using the meeting, you're not using your personal room, you're using a meeting that you specifically have a time, you're making it private, where each person has to be invited to the meeting, and that meeting has a password. Now you're raising the risk, that the risk level is being upped by several. You're making it much more difficult. You're taking rungs away from the security ladder for the attacker. Now, this is all things that you can do these are preventative measures. I would suggest there's another category of what happens when you're in the meeting and you are, when you do, what can you do once you're in a meeting? Now, there's some procedural things that you can do, considering what would happen once somebody, let's say something happens for whatever reason, the Zoom, you inadvertently, it's one of the last times you're doing a public link for a meeting, and you now have a scenario where there's a Zoom bomber in the meeting, or maybe someone's email has been exploited or something. What can you do in that model? So now we've gone from a preventative step to, okay, now that when the risk has actualized, what do you do about it? Now, first thing is, if you can, make sure that you limit who can actually do, screen sharing or share video. Limit that to what the meeting actually requires. So maybe it's just a host that needs to share. Keep it just to be the host. 2, eliminate the need for turn off private chat. That's where someone, potentially, if you have let's say you're doing it like a classroom exercise, or you're putting a group together for a meeting, that's where a Zoom bomber might go to somebody and send them a link for something that, might look legitimate, but hey, guess what? It's not legitimate. It could be something offensive, or even worse, could be effectively a spear phishing attack. So they've targeted you to go to this link, and when you click on that link, it's going to load malware. And those are the guys you really have to be worried about. Particularly if you think about, they might be preying on children in schools to get to the parents and everything else. 3, if you can have someone who's effectively, if you consider things like Zoom it's like a public forum. Yes, it's on, these meetings are it's like coming to a meeting room. And if, depending on, it might be a good idea to have someone to be a monitor or a chaperone, whose entire job is not to be the person running the meeting, but the person who's watching the meeting happen. And you might see this in larger we see this for a lot of executives who wouldn't know how to set up one of these set up a meeting. They have an assistant set up the meeting, watch the meeting, and control the meeting. That's another useful tactic in this case as well, because now you have someone who's not participating. They're not in the flow, but they're listening, and they can see something faster than the person presenting can. And they can remove the person from a meeting. And then fourth, from the mitigation component, and this is like, if all else fails, shut down the meeting. An attacker can't attack something that's not there, and that's a lesson in cyber defense. The simplest way to defeat a cyber attack is to unplug the asset that's being attacked. Or in the case of something like Zoom or any sort of online collaboration tool, you shut down the session. You remove the threat. That's your last, but that should be, you don't want to do that all the time, because then that's disruptive as well. That's you're doing a denial of service to yourself. So you look at these categories of things that are in the space of what I would do to be preventative measures to prevent the Zoom bombing from happening, and then the steps that can happen in case of, as a session is live, what you can do to take steps to remove the threat. Does that make sense?
Yes, but all these great cyber defense and cyber hygiene methods you propose are very good, but you do have an issue of employee mistakes. Do your remote teams, and they are remote, understand the cyber risks, company policies?
That's a great point, and let's look at that in that same, where we're going to put the leisure use of these technologies aside for a second. Let's look at this from a business perspective. Let's look at it from and I think that is another area where you have a lot of the workforce who is not used to using this technology, is not trained to use this technology. And you have to, I think that's another, the education of saying, here's what you do to prevent something from happening, and here are the tactics you use to do things as things are happening. There are actually more sophisticated things you can do with Zoom in terms of, whether or not you let someone go back in the room after you remove them. I was actually filtering a little bit of that out, because I'm thinking, when it comes to someone, let's say, that doesn't work in this day in and day out, you want to teach them 3 to 4 things. And it's fair, go in, keep it private, have a chaperone, and, kick people out. And if you lose control, kill the meeting. And that's, if you do something that simple and you build it around that, the idea being, I'd say from something I did I'm a former Army officer, so I would say, in the spirit of keeping it infantry proof, those would be the 4 things that I would do to facilitate that. And that's the same thing we've told, for my own team at Fornetics, we've said the exact same things. So if you're going to host a meeting, do these things. Do not, and so that cyber hygiene is critical, because, attackers ultimately, a lot of mistakes. Attackers will take advantage of people making mistakes. To your point, Leon, I think that's a great way to look at it. And so if you can train and, maintain that sort of appropriate posture where it becomes second nature, freedom through discipline, to prevent these things from happening, you're going to make it much more difficult for an attacker to take advantage of a populace that's effectively vulnerable. I mean, if you think about it, let's go back 10 years. Some of the issues we would see when you really started when we first saw phishing attacks coming on, they took advantage of a vulnerable population, and now they become more sophisticated, in terms of now you've got the idea of spear phishing and everything else like that, where these phishing attacks become more sophisticated. But think about where they were, 10 years ago. And because we start teaching good cyber hygiene, or start the process, get people in the mindset that someone will use a falsified email to get you to provide information you should not provide, getting that we made it more difficult. So the attacker had to up their game. They had to become more sophisticated. The only collaboration session that's truly immune to attacks is the one that never happens. That's a reality. but you can make it a lot more difficult.
Well, Chuck, that is very, very informative, and I'm sure everyone will be listening with fascination to that and taking very close notes. And thank you very much for your time.
Oh, absolutely. Thank you, Leon. If there's anything else, please don't hesitate to reach out.
And now let's talk to IFM Investors Chief Economist, Alex Joyner.
Alex, what's your view about the economic outlook? It's very, very grim at the moment.
Well, that's certainly true. I think there's been a rush, I guess, of forecasters looking to try and put a size to the I guess, precipitous fall in real GDP around the world. We've seen the IMF come out with their forecasts highlighting the deepest recession since the Great Depression, and even the Reserve Bank in Australia have come out and tried to put a number to this. I think because we haven't seen this type of episode before in which economies basically stop, I think economists are having trouble ascribing a number to it. The Reserve Bank's tried. Its first guess, I guess, came from Phil Lowe, and he thinks the economy, or the Reserve Bank's economist, and he think the economy will contract 10% in the first half of this year, with most of that happening in the June quarter, and that obviously would be something that's been unprecedented, which is the word of the crisis. So far, the unemployment rate heading up to 10%. We've already seen a little bit of evidence of that in some higher frequency data the ABS is bringing out. And within that labour market, the number of hours worked in the economy will shrink by 20%. So that dislocation coming from people working a lot less hours but still being employed because of the government's JobKeeper allowance that they've put through. So that will in part cushion the blow, and Australia's been pretty proactive in the fiscal space there, bit over 10% of GDP to try and cushion the blow of this unprecedented recession. That stands us in pretty good stead when you compare us to fiscal packages from around the world.
Well, the issue is that the economic pain is only just beginning, and we're going to see entire industries either wiped out or hastily transformed. But the reality is economists are peering into the great unknown, trying to understand a world that doesn't fit any economic models because they don't know how to model for economic conditions that have never existed before in anyone's lifetime.
Well, that's right. Economists and econometricians, such as myself, we don't have a model for this. We don't have a dummy variable for this. I sort of commented when we first started to see some of the survey data, the PMI data, come out in Europe and the US, and it falls off a cliff to levels that we've never even seen before. So sort of breaking all the charts, as it were. We haven't seen this type of episode before, so it's very difficult to model it. We're all sort of running around trying to ascribe traditional shapes to the recession as well. You hear of V shapes and U shapes and L shapes. Again, very, very difficult to ascribe a recovery path to a type of recession that we haven't seen before. The way I've been thinking about it is, the recovery will happen in 4 stages and not be really any shape that we can identify. The first being, economies stop and fall off a cliff. So basically real GDP goes down, between 10 or 20%, depending on what economy you're in. And that happens almost immediately because of the public health restrictions. We then get a period that is defined by the public health crisis. So a period of hibernation, as the government likes to put it. That's lasted a couple of months already. It will probably last a couple more before we see any meaningful restrictions lifted. So there's a flat spot at the bottom of this recession. And then we get something like a snapback. That's what the Prime Minister's calling it. I don't think it'll be very much of a snapback, but once we see some of the restrictions lifted, people going back to work and allowed back in the shops and restaurants and bars, we'll get a bit of a lift. But as you say, I think the economy will be scarred, and the way people actually operate in the economy will be different going forward. So, when we see that sort of snapback, it's not going to be just to how things were. It will be a sharp pickup in growth, but it certainly won't get us back to where the economy was in late 2019. I think that process will take sort of 12 to 18 months after we lift these public health restrictions, and the economy will be adjusting. We might be working differently and shopping differently and commuting differently. Certainly we'll be traveling on aeroplanes differently. So these are all going to be some pretty interesting and profound structural changes to the economy. We also then get onto some more difficult debates around just how the economy will look going forward. We need productivity enhancing reform. We know that. Will the government be able to take advantage of this crisis and get that through? What will our relationship with China look like? There's obviously a bit of political pressure coming from China for Australia not to join the chorus of economies or chorus of governments that are asking why. Where did the virus come from? How can we stop this happening again? And then there's this concept of economic sovereignty. And the argument there is, should economies like Australia bring back some of the supply chains to Australia for key industries, medical industries and high-tech manufacturing, the things our economy needs? And should we more broadly diversify our supply chains and trading partners? We've been very, very centralized in terms of our trading partners in Asia. Do we need to look further afield? We've got a free trade agreement with the EU that's currently in progress. That's a market of 500 million people. Do we need to go back to some of these traditional markets in order to diversify our trading relationships and try and make ourselves a little bit more immune to these shocks going forward? So there's a lot of things happening, I guess, in the Australian economy that we need to think about how we will operate in future. And I think it will be very different to how we've operated going into this crisis.
Well, the issue is that you're going to have entire industries will be transformed massively, and some industries will go out completely.
Yeah, that's right. Some of the industries that are under pressure because of this, tourism, education, we'd like to think they'll bounce back, but they're going to be under pressure for an extended period of time. And are we going to go back to the way that we were, where 1 in 4 international students was from China, 1 in 6 tourists was from China? Those sectors are not necessarily going to bounce back in any rapid way. International travel is going to probably be one of the last things to come back in all of this. So, there's going to be certain industries that remain under pressure for an extended period of time, and they may have to do things differently going forward when we come out of this.
Well, that's going to be interesting to watch. And also, what concerns me is there's going to be a massive increase in fiscal deficits at a time when public debt levels in many countries are already high, if not unsustainable.
Yeah, that's it was interesting. There was comments by the Fed chair Powell overnight saying that debt and deficits, we can't worry about that right now. We need to use fiscal policy to right economies and cushion the blow on economies, because we know that monetary policy is sort of at the end of what it can credibly do and effectively do. So we've seen that around the world. I would say the one positive that we have in Australia is that our fiscal metrics going into this were relatively good. We weren't, say, the US, where they already had a huge deficit. Some European countries already had huge deficits and debt levels. Japan's another one where they're obviously huge debt. Australia going into this, if you believe the government had a broadly balanced fiscal metrics or underlying cash balance, as we'd call it, and we had a relatively low level of net debt, and we even had a relatively low level of gross debt. Gross public debt going into the crisis in Australia, this is Commonwealth and state government debt as a proportion of GDP, was around 45%. That will blow out to about 65%, and we'll have a fiscal deficit at the Commonwealth level of around 10%. Arguably, or a little bit more, depending on how those fiscal stabilisers work. But these governments have had to do this. They've had no choice. The Reserve Bank really hasn't been able to do a lot at this stage, but really the onus has been on fiscal policy makers. And we wouldn't argue that they shouldn't have done anything. They clearly should have. But Australia, like I say, has been in a relatively good position, and it will actually be in a relatively good position going out of this. Funnily enough, even though we've spent a lot, around 10% of GDP on fiscal support so far, and there's likely more to come in terms of fiscal stimulus as we exit the crisis. Our debt to GDP, public debt to GDP coming out of this, say mid-60s, it actually compares quite well to the G7 average going into this crisis, which was actually 91% of GDP. So we're still better off than a lot of countries coming out of this as well. But inevitably, there will be pressure on future governments to sort of right the fiscal ship, as it were, and bring fiscal metrics back to a more sustainable basis. And that will mean, fiscal policy will be contractionary in Australia for a long period of time, at a time where monetary policy is pretty stretched, for want of a better phrase. So what I think will happen in this case, where direct fiscal stimulus is limited and direct monetary policy stimulus is limited, is governments are going to need to do more on the reform agenda and productivity enhancing reforms, basically because they will have no choice but to do so.
Well, that's lots of things to think about, Alex, and it's certainly going to reshape the economy. And thank you very much for your time, and thank you again, and stay safe.
Thanks a lot, Liam. You too.
So what's happening in the news? Well, the Federal Treasurer has outlined what he has dubbed a sobering economic outlook on a day when he'd long hoped to deliver Australia's first budget surplus in more than a decade. Instead, Treasurer Josh Frydenberg delivered in the Parliament an economic update, which experts expect will represent the largest budget deficit in Australian history. Mr Frydenberg said the underlying cash deficit at the end of March was $22.4 billion, almost $10 billion higher than the government forecast in December's mid-year budget update. He said tax receipts were $11.3 billion below December's expectations. The Treasury expects gross domestic product will fall more than 10% in the June quarter, representing the biggest fall on record. The Treasury expects household consumption to be around 16% lower in the June quarter. It is forecasting business investment and dwelling investment will both be down 18%. Non-mining sectors are likely to face bigger falls in business investment. Mr Frydenberg warned that if restrictions were reimposed, it would produce a loss of more than $4 billion per week to the economy. If hardline restrictions were reimposed, it would cost the New South Wales economy $1.4 billion, the Victorian economy $1 billion, Queensland $800 million, Western Australia $500 million, South Australia $200 million, Tasmania and the ACT $100 million, and the Northern Territory $40 million. An opposition leader, Anthony Albanese, has warned against a snapback to the problems of pre-coronavirus Australia, calling for a reshaping of the national economy. Albanese delivered a broad-ranging vision statement, pushing high-speed rail, decentralised government services to boost regional areas, affordable social housing, and a revitalised manufacturing sector. And even before coronavirus, wages growth was slowing. The Australian Bureau of Statistics has reported wages growth of just 0.5% in the March quarter. Annual growth is at 2.1%, a drop from the March 2019 result of 2.4%. And the NAB Business Survey found that with non-essential services shut down throughout April, business conditions deteriorated further. This was despite the announcement of JobKeeper on the 30th of March and the sharp decline in new daily COVID-19 cases during the month. Confidence did pick up from its record low, but is still much weaker than during the GFC. The employment index and labour costs fell significantly, signalling a sharp downturn in demand for labour, corresponding with ANZ job ads data. Business conditions fell 12 points to minus 34 in April, while confidence increased 20 points to minus 46, still considerably weaker than during the GFC. All components of business conditions, profitability, trading and employment fell further in April as capacity utilisation contracted by a further 3 percentage points to 72%. And credit and debit card data show Australians are starting to open their wallets, with their food, alcohol and home furnishing spending now higher than this time last year as COVID-19 restrictions ease. Commonwealth Bank data shows that while overall spending in the week to May the 8th is still down 2% on the same week last year, it has bounced from mid-April, where spending was down 20% on the same week last year. The smaller states and territories recorded growth compared to a year ago. Spending in Queensland increased, indicating its earlier easing of shutdown measures is working to stimulate the economy. And the easing of lockdown restrictions in some states has pushed up retail spending considerably. During the week ended 9th of May, Total ANZ observed retail spending was 22% higher than the same week in the previous year. Consistent with people getting out and about, online spending has softened from 20% of total ANZ observed spending to 15%. ANZ expects spending to spike each time lockdown restrictions ease, but the longer-term trend of retail spending is likely to be weak, reflecting reduced incomes and financial stability for many households. And the coronavirus shutdown has caused a surge in unfair dismissal claims, with new figures showing 65% more cases than the same time last year. Data from the Fair Work Commission revealed a hike in workload thanks to more cases about dismissals, stand-downs and JobKeeper disputes. For the latter, top issues were changes to working hours, stand-downs and eligibility for casuals. More than 1 million Australians have reportedly lost their jobs since social distancing measures were installed. And China has suspended meat imports from 4 Australian abattoirs, fueling concerns that escalating tensions between the two nations are damaging Australia's most important trading relationships. The suspension will start on May the 12th, according to a statement on a customs website. The floor plants make up about 35% of Australian beef exports to China. Australia has stoked tensions with China in recent weeks by calling for an independent probe into the origins of the coronavirus pandemic. Australia is also facing the looming threat of major tariffs on its barley shipments to China. The Australian dollar dropped as much as 0.9% to 64.32 US cents. Australian Agricultural Company, the nation's largest integrated cattle and beef producer, fell as much as 5.6%, the most in 6 weeks. Elders Limited, which helps sell and buy livestock across Australia, China, Indonesia and Vietnam, dropped as much as 6.9%, the most since March the 23rd. While a spokesman for China's foreign ministry said on Tuesday the beef imports were suspended to secure the health and safety of Chinese consumers, he also criticised Australia's pursuit of a probe into the origins of the coronavirus first discovered in China. The spokesman, Zhao Lijian, denied the two issues were connected, telling reporters in Beijing, "I don't think you should take them as one or make any erroneous political interpretations." Chinese customs found products exported by certain Australian companies violate the inspection and quarantine requirements jointly decided by the competent authorities from both Australia and China, Zhao added. And the dairy industry has called a snap meeting with the federal government as fears grow of a third trade strike from Beijing in retaliation for Australia's pursuit of a global inquiry into the coronavirus. And there's been a massive 98% plunge in the number of arrivals at airports and maritime terminals in the past 2 months, as COVID-19 travel restrictions here and abroad have brought international journeys to a virtual halt, according to a senior Department of Home Affairs official. Department of Home Affairs Deputy Secretary Cheryl Ann Moyes said there were 1.1 million fewer people than normal passing through the nation's borders between the beginning of March and May the 10th, underlining the scale of the damage caused to industries including accommodation, tourism, education, aviation and agriculture caused by the lockdown of the nation's borders. And Australia's research workforce will be severely impacted by the coronavirus pandemic, and the effects are likely to be felt for an extended period. There are warnings 21,000 full-time research jobs are at risk due to the coronavirus. The nation's peak scientists and academics warn it will be worse than the GFC. Universities are ineligible to get the JobKeeper wage subsidy for their workers. That's the conclusion of a Rapid Research Information Forum, or RRIF, paper titled Impact of the Pandemic on Australia's Research Workforce. The paper was sent to the federal government's National COVID-19 Coordination Commission, as well as senior ministers Karen Andrews, Greg Hunt and Dan Tehan last week. The pandemic is expected to disrupt the sector more than the global financial crisis, with the scale of the revenue losses for universities from the COVID-19 pandemic likely to be worse in 2008, the paper warns. It estimates that 21,000 full-time equivalent jobs in the university sector are at risk during the next 6 months, with 7,000 estimated to be research-related academic positions. The RRIF is made up by Australia's leading scientists, researchers and academic institutions. Research work at tertiary institutions is funded by government, non-government grants, industry and discretionary income allocated by universities. And Cochlear says the deferral of elective surgeries in key markets led to a 60% year-on-year slump in revenues during April. The Cochlear implant supplier says unit sales across developed markets fell 80% in April as surgeries were postponed in the US and Western Europe. The company says surgeries in China recommenced in late February and continued to recover throughout April. Surgeries are now running close to pre-virus run rates, despite Beijing remaining closed to elective surgeries. Cochlear Services, which represents around 30% of business as usual revenue, has also been affected, with April sales down around 30%. And can Australia support a third airline? Regional Express Holdings, or REX, will capitalise on the turmoil from Virgin Australia's collapse and invest $200 million launching capital city services to compete with Qantas, Jetstar and Virgin Mark II. In a move that could harm the sale price achieved by Virgin's administrators, the regional airline operator is working on a business plan that includes leasing 10 narrow-bodied jets as well as employing new pilots, cabin crew and ground staff. Virgin's administrator, Vaughan Strawbridge, has called for indicative bids for Virgin to be lodged by Friday. Industry sources say the business was worth around $1 billion, depending on the amount of secured and unsecured debt. And online retailer Kogan.com reports that active customers grew by 139,000 to 1.948 million over April due to the stay-at-home economy. It also reported gross sales more than doubled for April, with gross profit up more than 150%. And Westpac will reassess the need for thousands of highly paid technology staff to be in its major city offices after seeing productivity increase among its developers and major products delivered successfully by home-based teams during COVID-19 restrictions. The bank's Chief Information Officer, Craig Bright, said it's part of an executive group planning how it will safely return staff to its offices as lockdown measures relax. But he said recent months had shown many tasks previously thought to require in-person group collaboration could be done from home. And bad news for super funds. According to Super Ratings estimates, the median balance option rose 2.7% in April. Given the extent of the falls in February and March, the return since the start of 2020 is minus 8.1%, while the rolling one-year return is minus 2.5%. And CSR has reported a 10% fall in profit from continuing operations to $125.3 million, as the building materials supplier warned of uncertain impacts on key markets in the 2021 financial year. And Australia's biggest bank, the Commonwealth Bank, has set aside an additional $1.5 billion for loans that go bad due to the coronavirus crisis. CBA also revealed a 23% fall in cash profit over the latest quarter, as efforts to contain the virus and initiatives to keep the economy moving hit home, falling over the quarter to March 31 to $1.3 billion from $1.7 billion at the same time last year, as conditions deteriorated at the end of the quarter. And customers doing more digital banking during COVID-19 say they're highly satisfied with the experience, and 1 in 5 reckon they'll use branches less or stop visiting them altogether when the crisis ends, a survey by Boston Consulting Group has found. The data could give banks confidence to continue to reduce branch numbers, as it suggests customers recognise that service through digital banking channels can be better than the branch experience. The survey also shows customers are becoming more comfortable applying for new products through the bank's websites and mobile apps. The BCG Ribex Pulse survey of retail banking customers around the world found that over the past 4 weeks, 35% of Australian customers have been using their mobile banking app more often. Of these, 95% have been satisfied with the technology. A quarter of customers are using online banking more often, with a 92% satisfaction, while over the COVID-19 period, 36% of customers reduced the use of branches, even though banks have worked hard to keep them open as essential services. BCG found that of the 30% of Australian bank customers who were not using digital banking before the coronavirus struck, 1 in 6 have been converted to becoming first-time digital customers over the past month. And the corporate regulator is carefully scrutinising COVID-19 related disclosures. Australian Securities and Investments Commission Commissioner John Price said he supported efforts to protect companies hit by the coronavirus, but will not tolerate anyone taking advantage of the crisis. A special team has been set up inside ASIC to monitor people using very aggressive advertising and pressure selling tactics in this difficult time. ASIC's Head of Compliance, Kevin Lewis, said the exchange had discovered 50 misleading announcements related to COVID-19, preventing most of them from being released while forcing the others to be amended or retracted. Among them was Advanced Nanotech, whose shares were suspended between March 16th and April 2nd. After the ASX queried claims it had potentially discovered and patented an oral care product that could inhibit the coronavirus. It returned to the market after retracting all announcement related to the treatment. And the federal court has ordered aged care provider Bupa to pay $6 million in penalties and millions more in refunds for residents who paid thousands of dollars a year for services they never received. The ACCC identified 95 extra services from Bupa across 20 aged care homes, some of which were never provided. Some residents paid for golf trips, travel escorts and air conditioning, but never received the service. Bupa began an $18.4 million redress scheme in 2018 and has paid out $14.1 million so far. The ACCC pursued Bupa for misleading and false representations to aged care residents for extra services the regulators said were not provided in full, if at all. And that's it for this week. And next week I'll be talking to Patrick Coughlin, CEO of Creditor Watch, on new payment data suggesting that SMEs were struggling with cash flow issues long before the coronavirus lockdown measures came into place and were unprepared for the current downturn. And I'll be talking to Indeed economist Callum Pickering about the latest unemployment and wages figures and what they mean for the economy. In the meantime, you can find me on Twitter talking BizBRZ, on Facebook and on LinkedIn. And if you want, leave a comment. Wishing you all a safe and